Hello friends, this is Ram and I am a co-founder and director of MadOverInsurance. People say we eat, sleep, think only insurance. So we are bringing you interesting videos related to insurance and customer experiences. Please subscribe to our YouTube channel MadOverInsurance and also follow our website www.madoverinsurance.com and also our social platforms.
Good morning. Let's look at surety bonds for infrastructure projects. The budget for 2022-23 allowed the use of surety bonds in place of bank guarantee for any government procurement. Shri Nitin Gadkari, Union Minister for Road Transport and Highways, launched India's first ever surety bond insurance product from Bajaj Allianz. Let's briefly understand what a surety bond insurance is. If you look at a surety bond insurance, the surety, we have one party which is called the surety. It's a neutral party like an insurance company which guarantees the contractor's obligation towards the principal. Then we have the contractor, the party who is required to obtain the surety bond. Example, a contractor undertaking large infra projects. Then we have the principal who is awarding that contract, who is requiring that contractor to obtain the surety bond. Example of a principal could be NHAI or the National Highway Authority of India. What are the advantages of surety bond over bank guarantee? Normally, surety bond requires lower collaterals due to which the capital of the contractor gets released. Contractors can use working capital more effectively. Let's now understand the surety bond insurance in detail. Normally, insurance policies have two parties. One is the buyer of insurance, other is the seller of insurance. However, surety bond insurance has three parties. As we had seen, we had the principal, we had the contractor, we had the surety. Normally, whenever any infrastructure project is given, there is a contract between the principal and the contractor for the construction works. If the contractor fails to comply with any of the conditions of the contract, then the principal invokes the bank guarantee. If surety bond insurance is taken place in place of bank guarantee, the bond would be called upon by the principal and the insurance company would make the payment to the principal. Insurance company, after paying to the claim, has subrogation rights based on which insurer will try to recover the losses from the contractor. Surety bond insurance can be conditional or unconditional. If it is unconditional, it is as good as a bank guarantee. But if it's a conditional insurance wording, then insurance company settles the claim only after satisfying itself about the allegations of breach and the quantum of loss suffered by the principal. There can be many different types of surety bonds. Some of the different insurance products are, one is called the bid bond, second is called the performance bond, and third is called the maintenance bond. If bidder is awarded contract, he does not accept the contract, this policy pays compensation to the principal. In the performance bond, if the contractor defaults on the contract term, then this bond will pay to the principal. In the maintenance bond, if the contractor fails to remedy defects as per the defects liability terms of the contract, then the bond will be paid to the principal. One question that comes up, will really the surety bond insurance succeed in India? If the surety bond insurance has to succeed, Governmental agencies like the National Highway Authority of India have to make the surety bond wording a part of the tender document. Second important thing is assessing the risk is a very specialized subject. Banks have better resources than insurance companies. Insurance companies need specialized underwriters for this. And if the surety bond insurance has to succeed, reinsurance support is very critical. If these three factors are fulfilled, there is a chance of the surety bond insurance succeeding in the market. Thank you.